So two things we have for tonight. One is we're going to round up on financial instruments, and also we would have to start impairment of non-current assets. Or I would just try and finish up financial instruments tonight. Then I guess next class we would finish up impairment of we'll start and finish impairment of non-current assets. And at the beginning of this diet, we were supposed to be having some makeup classes. We only did two, and we stopped. We would have to resume that, because if you remember, based on our analysis, um, considering the time period we have for the part I want to cover, it's not just enough for us to cover it, which is why we said we would need additional time for makeup. So have it in mind that this week we would have one makeup class, and most likely is either we are looking at IFRS 15 on revenue, or we look at IFRS 5. I would look at any of the two. I need something we can start and finish on Thursday. So we'll look at that. So tonight, we would I would have to start from measurement of financial instruments, because some of my students complained that the notice we gave for the last class was quite short, and for that reason they could not join. And I was well aware of that, so I didn't really go so far that day. But at least if you were present that day, so you're going to have a little edge today, because I would revise it and proceed to the remaining part of financial instruments. Remember clearly that financial instruments is all about debt and equity instruments. And I mean, it's just ways of raising money, the ways companies, individuals, even governments raise money. And also, we are looking at IAS 32 and IFRS 9 to learn how to treat these instruments. For IFRS 2, I remember vividly, around two weeks ago, that was when I taught you that. And the emphasis of IFRS 2, said IFRS 2, IAS 32, is how to know the instrument an issuer has issued. Because when somebody wants to borrow money, they issue an instrument, or when they want to raise capital, they issue an instrument. So it's either they are issuing debt or equity. So IAS 32 really teaches us how to identify whether the issuer has a debt or equity. I gave you several scenarios. I even gave you assignments to be able to identify what an issuer has. Is it debt or is it equity? Ultimately, on all the scenarios we gave you, you should have identified that an issuer has a financial liability if there is a contractual obligation to deliver cash. If that obligation exists, then we have a financial liability. Otherwise, we have an equity instrument. I mean, it's so interesting that one of the assignment I gave you, the issuer issued a bond. I mean, bond ordinarily is a debt. However, we're not told that the interest on the bond is not compulsory that the issuer pays it. I mean, it's optional. I mean, they said it will be paid at his own discretion. And the answer to that, because the question was, okay, the issuer, is that a financial liability or equity? The answer is equity, even though the instrument was clearly a bond. But the fact that the substance of that arrangement is that the issuer does not have to pay interest. That means he has no obligation to deliver cash. And when there is no obligation to deliver cash, there is no liability. Then the issuer has equity. Okay, so that part of your syllabus, that part of this topic I taught you of financial instruments, it's very important. And all you need to do, go to that first video, watch it and watch it again. Make sure you master it. That video was very practical because I intentionally taught you by painting a lot of scenarios for you. And I gave you a lot of assignments like that. Okay, now the second part is what we're supposed to look at last week, which we did, but we did not finish. So today I would start from where I started last week, and I'll finish it up today. Now, what we are looking at is measurement of financial assets, how you measure financial assets. So fundamentally, measurement deals with how to get the value that you attach to an item, the value. Now, looking at financial instruments, there are three elements. Financial instrument has three elements to it. There is the financial asset, there is the financial liability, and there is the equity instrument. So our objective is to learn how to measure all of these three. I'm going to place emphasis only on these two because standard didn't really mention so much around equity because this is country specific. Like in Nigeria, the way we measure equity is share capital, right? And when you have share capital, the way we measure it is we measure it at nominal value. Share capital are measured at nominal value. And every company, when you are registering your company with CAC, you will have already established or registered the nominal value. Some people don't know how important that nominal value is. They will share a register company and put one nominal value there. And ultimately, when we auditor go to field and we are auditing the account, it's the nominal value you put in your CAC document that we are going to use. That's the basis in Nigeria. That's the requirement of CAMA. So ultimately, we will now find out that they have even the share capital they have, the money they have invested in the business, the capital is more than the capital in their CAC document. And the requirement is that is your share capital in CAC that should reflect in your account. So what we do for them is we give them two options. Is that we're going to update their CAC documents to reflect how much the total amount they have invested in the business as capital, or if they're not ready to do that, or if that process is going to take some additional time, we probably would create a director's current account. Then we put that additional sum in that director's current account. It will just be there, still under equity, but not on that share capital line. Okay, pending when they update their share capital with CAC. Of course, you can increase your share capital with CAC, even though you cannot reduce it. It's not allowed. So now, said that, you would see that equity instrument is measured at nominal value in Nigeria. And we would really want that whatever share capital you have in your account is a mirror, it must be a mirror image of what you have in your CAC document from, I think, CO7. So they must mirror one another. Okay, that's equity. And you know that it's possible for you that when you're now issuing shares, you can issue shares at more than the nominal value. And I mean, any excess above the nominal value goes to share premium account. So that's the way that works. So no issue with that. Okay, now let's focus on financial assets and financial liability. I will start with financial assets. How do we measure financial assets? And don't forget, when we say financial assets are three things. Number one is cash. Number two is equity instrument of another entity. Number three is contractual right to receive cash. Those are the three financial assets that we have. So cash, how do we measure cash? Cash is cash. Your cash is the amount you have either in your hand or in your bank. So it's cash. There's no difficulty in measuring it. You know how much you have, and that's how much you put in your books. So no issue with that. The second one is equity instrument. How do you measure that? Okay, this is when now we need to really give it some thinking. So you see, equity instruments, as far as financial asset is concerned, means that you have bought shares in another company. Then how do you then go ahead and measure that? Okay, so firstly, anytime you mention financial instruments, firstly have it in mind that initially is measured at transaction price. Note that all financial assets are initially measured at transaction price. That is the amount you invested, the money that you paid for the instrument. That is the transaction price, and that's the amount you put in your books initially. All financial, anytime you invest, how much did you invest? That is how much you put in your books. Now, let's narrow it down. Equity, investment in equity. You bought shares, you're an investor. You have a financial asset. So how do you then go on from there? I've said that when you buy shares, when you invest in any financial asset, the amount you put in your book is the transaction price. See, however, narrowing down to shares, which is equity investment, there are different reasons why you would buy shares. And those different reasons have different accounting treatment. And the standard noted that the different reasons will lead us to what we call classification of these financial assets or equity investment. So when you want to measure or when you want to account for an equity instrument, immediately you buy it, you need to be thinking of how do you classify it. And the reason this is coming up is because there are different reasons why you would buy shares. Unlike PPE, for example, now, if somebody buys air condition, everybody knows why you have bought it. It is to make your office environment conducive. If you buy furniture, everybody knows that because you want to, it's for administrative purposes. Those ones are clear. But when it comes to buying shares, people have different motive, and which results in what we call classification. And how would this impact? How do you then classify? You see, first, this motive or intention for buying these shares can either be buying it to hold for the short term or for trading, or buying it to hold for the long term. Which means that as soon as you invest in equity, as soon as you buy shares in another company, and you want to account for it, you need to identify what's your intention. Why did you buy? Because there are more than one reason. And IFRS 9 is saying that is either you are buying it to hold for the short term or you are buying it to hold for the long term. You need to identify this. Because if your intention is to hold these investments, these shares that you have bought, if your intention is to hold it for the short term, then you are going to classify that shares, that investment in equity is going to be classified at the date you bought it. At the date of acquisition, it will be classified at what we call fair value through profit or loss. Fair value through profit or loss. If your intention is to hold it for the short term or for trading. But if your intention is to hold these shares for the long term, you will classify it as what we call fair value through other comprehensive income. To be classified as fair value through other comprehensive income. So following from this now, we can see that there are two classifications of equity investments: fair value through profit or loss and fair value through OCI. Those are the classifications that we have. And I need you to understand something, that when I say that your intention is to buy shares for the short term or for trading, it doesn't mean that you have the intention of selling it within 1 year. It could be more than 1 year. It's not just 1 year. It's not about the period, but more about, do you want to sell? Do you have the intention of selling? So even if you have the intention of selling and you are not selling it within 3, 4, 5, 6 years, it is still classified as that you are holding it for short term or for trading. I mean, what makes us conclude and agree that you are holding it for short term of trading is the fact that you have the intention of selling. So whether you want to sell in the short or long term is not really our concern. Our concern is, do you have the intention to sell in the future, in the near future? If it's yes, then we say you are holding it for short term or for trading. If you don't have the intention of selling at all, if it doesn't cross your mind, that means you're holding it for the long term. Okay. Now, look at this guy, Asu PLC. He bought 5,000 units of shares of BPLC at 2 naira on 4th January 2004. And Wasu PLC intends to sell the ordinary shares before the end of the year. How will the investment be initially measured and classified? Again, I told you that when you buy shares, when you invest in equity, you initially measure them at transaction price, which is the amount you paid. Now, this guy paid 2 naira per share for these shares, and there are 5,000 units of shares. That means the transaction price is 5,000 times 2 naira, which is 10,000 naira. So that's how it's going to initially measure it. However, I told you that at the date of that measurement, at the date of that acquisition, you need to classify it. You need to know what's the intention of buying it, which is what will ultimately determine the classification. And we're told that this guy have the intention of selling before the end of the year. That means it's held for short term or for trading. So that means it will be classified at fair value to profit or loss. It will be classified at fair value to profit or loss. Okay. However, when he wants to enter this in his book, okay, the double entry is that since he is buying shares, he will debit financial assets, but the account head will not just be called financial assets. Since there are two classifications of financial assets, fair value through profit or loss and fair value through OCI. So that means that it needs to clearly state which of them, it needs to clearly state the classification. In this case, since he has the intention to sell, that means this is how it's stated: fair value, financial asset at fair value through profit or loss. That is what is going to debit in credit bank with that 10,000. Okay, so that is what they do or is done at the beginning of the year. Also, when you buy shares, when you invest in equity, you would often incur transaction costs, which are costs related to broker's fees. It's not possible for you to buy shares without incurring all these related costs. They will charge you. There will be stamp duties and these other taxes. There will be the NGX, they have their own fee. The stockbroking firm have their own fee. All those attributable costs, they are what we call transaction costs. So the key thing is that this transaction cost, how do you treat it? How do you treat it? Because you ultimately pay it. Then when you pay your credit bank, right? So The corresponding debit, where does it go? So, see, the treatment of this transaction cost depends on how the financial asset is classified. It depends on the classification of this financial asset. So if this financial asset is classified at fair value through profit or loss, you would expense this transaction cost. But if it is at fair value through OCI, you capitalize this transaction cost. You would capitalize it. So that's transaction cost, brokers fees, and the rest. Please remember that's how it's treated. If so, the treatment depends on how you have classified that financial asset. If it is classified at fair value through POL, you expense the transaction cost, but it is capitalized. If it is classified at fair value through OCI, you capitalize the transaction cost. Okay. Now, at the end of the year, which is subsequent measurements, so I mean, you hear me say subsequent measurement a lot because at the end of the year, we usually get how much is the value of our assets, liabilities, and all of that. In this case, is investment in equity. So at the end of the year, how do you measure it? And I mean, interestingly, we measure it exactly how you have classified it. That is, at fair value through profit or loss, at fair value through OCI. And I said here that the subsequent measurement must be consistent with the classification in the sense that if you classify at the beginning or when you bought that investment, if you classify it at fair value through POL, we expect that you should measure it at the end of the year at fair value through POL. And if you classify it at fair value through OCI, we expect that you measure it at fair value through OCI. So that's how you measure at the end of the year. But the big question becomes, what's the difference between these two? When you see that you're classifying at fair value through POL, you're classifying at fair value through OCI, what is the difference? See, the difference lies in when there is changes in fair value. How do you treat those changes in fair value? That is where the difference lies. And ultimately, these measurements are basically fair value. Is fair value, which is the amount you would receive when you sell this investment. So now, when we say fair value through POL, it means that if, for example, at the end of the year, let's say I'm following up from this example I gave you, where you bought shares for 2 naira. Okay, so let's assume at the end of the year, the share price rose to 3 naira. Okay, it means that it's the value of the shares now is now 5,000 times 3 now, which is 15. And don't forget, at the beginning of the year, the value of the shares were 10,000 because the price was 2 naira. It shows that this guy has made a gain of 5,000 naira. Has made a gain of 5,000 naira. So this gain now is what we are asking. Where will it go? See, if you are measuring it at fair value through POL, this gain will go to POL. But if you are measuring it at fair value through OCI, this gain will go to OCI. That is just the difference. It's no more than that. Okay, so that is that for equity investments. Any questions, please? Okay, let's see if I can see your hand. You can go ahead, please.
Can you hear me, sir?
Yes, please.
Okay. Thank you and well done for the good job, sir. The Lord continue to be your strength. Sorry, before we move further, sir, just quickly want to perfect your explanation here that if the financial assets have initially been mentioned at profit or loss, fair value through profit or loss, then that, sorry, I'm coming, the transaction price will be expense. So does it mean that we will debit profit or loss account and will credit bank?
Yes, and it's not transaction price, it's transaction cost.
Transaction costs. So thank you, sir. Then if it is measured at other comprehensive OCI, sir, does it now mean that we will credit bank, since you said we will capitalize, and we equally add the transaction cost to the OCI?
Capitalizing means you add it to the cost of the assets. So assuming that, let's say the transaction cost in this case was 200 naira, and we bought investment of 10,000. So when we say we are capitalizing, it means you're going to add that 200 naira to this 10,000 in
Okay,
your
everything goes to
financial asset.
OCI.
Not OCI, to the financial asset account. Capitalizing means you add it to the assets.
Okay. The something will now be 10,200 naira, the value.
Yes.
Thank you, sir. Thank you, sir.
Yeah. Any other question? Okay. So now, this 5,000 naira gain that you made, I told you that if you're measuring it at the end of the year at fair value through POL, say this,
Excuse me, sorry, I have a question.
okay.
Okay, so I want to understand, because I think he's trying to understand what will now reflect on the OCI. The financial assets is not different from the OCI. So if it's not fair value at OCI, so what is now reflecting? OCI is under sorry, it's after the profits, right? So what is now reflecting there?
If I understand your question, I'll be mistaken. In terms of what exactly? What are you relating to? Are you talking about the transaction costs?
Transaction cost, yes, sir, of the asset.
I think I was very clear enough that, that is just clear. And I want you to take it as simple as it is. Don't look for what is not missing, right?
Okay.
When you have broker's fees, transaction costs, any attributable costs, such costs would be expensed if that financial asset is classified at fair value through POL. Expense it, take it to POL. But if that financial asset is classified at fair value through OCI, capitalize it, add it to the cost of the asset. So I don't think you should now be looking for, okay, what will now go to OCI? The principle is capitalize it.
Okay. Okay, noted.
Okay. Now, I really want you to note this other one, these subsequent measurements, okay? Because the way we have classified is the way we have measured at the end of the year. So like I've mentioned, the difference between this fair value through POL at the end of the year, fair value through OCI at the end of the year, is just how you treat the gain you make. Because when you buy shares, you are aware that the share prices fluctuate, it goes up and down like that. So whether you're making a gain or a loss, how do you treat those changes in fair value? Say that's where the differences between these two lies. If you're measuring at fair value through POL, you are going to definitely take that gain or loss to POL. If you're measuring at fair value through OCI, you take that gain or loss to OCI. I mentioned that, and I'm mentioning it again. But let's look at the complete picture, because I was waiting for somebody to ask me that. Since you didn't ask, let me assume you know. So let me ask you, just to be sure that you actually know. Let's say this 5,000 naira gain. Let me start from here. What would be the double entry of this 5,000 naira gain?
Hello, sir.
Yes.
If measured at profit or loss, fair value through profit or loss, the
Okay.
gain will be credited to POL.
Okay. Where will you debit?
Let me leave that one to another person.
Don't leave anything to another person. What will you debit? It's simple. I mean, look at it. We want to take the financial assets. In fact, the financial asset has increased from 10,000 to 15,000. That's why we are making a gain. So yes, that gain is an income. If you're measuring at fair value through P&L, you credit your P&L. What would you debit? You should know. The financial assets, so that you can go up from 10,000 to 15,000. Debit the financial asset because the value has gone from 10,000 to 15,000. So is the way we do it in accounting is through debit and credit, because we don't clean and change figures. No, we passed journal. Okay. Yeah, you see, all of these journal I keep mentioning every time, you find out that you would see very little of them in your exams. But I mean, it would be unfair for me to teach you reporting, and I'm not telling you debit and credit. That will not be so good. So you debit the financial assets with 5,000, you credit P&L. Again, if you're measuring at fair value through OCI, that means this 5,000 naira gain will be credited to OCI and you debit the financial asset. Okay? So please note that as well. And note that if it were to be a loss, it's the same thing, just that losses will now be debits. You debit P&L, you now credit the financial asset. Something like it's like the reverse of that. Okay, let me ask you another one. Let's say in year 2, okay, let's say this year 1, we made a gain 5,000. And let's assume we are measuring the financial asset at fair value through OCI. So we made a gain of 5,000 in year 1. So it went to OCI. So let's say in year 2, we now made a loss of 7,000. How will you treat this loss? Where will it go?
The loss will, since it is loss, if it is measured at a fair value through profit or loss, the loss will be debited to.
No, it's measured, let's say it's measured at fair value through OCI. Leave
Through
profit or loss.
OCI.
Yes.
I will debit OCI and will credit a loss, will debit P or
You know
L.
that this is year 2, we made 7,000 in year 2, and in year 1 we had a 5,000 naira gain, and in year 2 we now had a loss of 7,000. And so how will you treat this loss if it is measured at fair value through OCI?
It will nil off the loss then for now.
Will debit you P or L and will credit the value of the financial asset.
With how much?
I think that should be 7,000 or 2,000.
Then any other person that can try. That's not right. That is not right.
So I think you said we cannot, recover more than the gain that we have recorded on it before. So the only thing that will be taken from recorded to the P&L is the 5,000 that increased on the share before.
So we take 5,000 to P&L. Is that all?
Then
People are not reading in this class. So you cannot even apply the knowledge I taught you in PPE. That means you have not
That's
even
right.
read.
Maybe we'll debit OCI with 5,000 and debit P&L with 2,000. Then credit financial assets with 7,000.
Thank you. At least she applied the knowledge she learned from PPA, which I expect that you would apply. And Muibat also has written the same thing also. Okay. So, but what Muibat wrote is actually the correct answer. Okay. What Muibat wrote is the correct answer. Okay. So, but I mean, Aisha applied the knowledge she got from her year 16, which I mean, unfortunately, it doesn't apply here. It doesn't apply here. It's in year 16 that I taught you that when you have a previous evaluation surplus, you now have a loss in the next year. That loss will need to net off or nil off that surplus in OCI first, and any excess can then go to POL. So I appreciate the fact that you're able to recall that, which is what I was expecting from you guys, right? So at least one person mentioned it. So, but that knowledge doesn't apply for financial assets because unlike PPE, that was not very specific in terms of where losses and gains should go to. You just say revaluation gain, revaluation loss. This one is very specific where gains and losses should go. Look at it. Fair value to P&L. Fair value to OCI. It means that come grey, come shine. Anytime you make losses or gain, if you're measuring at fair value to OCI, put those losses or gain to OCI. If you're measuring at fair value to POL, put those losses and gains to POL. So even though you made a gain in the previous year and that gain has gone to OCI and you're making a loss in the current year, it should now until we go to OCI, but it will not be a deduction, a debit, since it's a loss. So the idea of, okay, you want to net off previous losses, then any excess will now go to POL. That one does not apply here. Now that you have made a loss, if you are measuring at OCI, you take the entire loss to OCI straight on. If you are measuring at fair value to POL, the entire loss goes to POL. That is the way it works for financial assets. No netting off here, like we did in year 16. And I hope that is extremely clear. Okay, so that is everything for equity investments. It's quite straightforward, and I promise you, it's no more than this. So if you know this, you know all. You know all. And I'll also send you some questions for you to practice and send back to me and all of that. But this is everything. So let's go to debt investments. Investments in debt instruments. Don't forget that we are still talking about financial assets. So, and financial assets is cash. There is investments in equity, which is when you buy shares in another company. And there's investments in debt. I mean, that's when you lend people money. When people are owing you money, you borrow them money, something like that. So how do you measure that? I mean, initially, when you invest in debt, you measure at transaction price. All financial assets are measured at transaction price. So that is a given. However, you see, at the date you'd lend those people money, there are different reasons, different intentions why people would invest in debt, why people will lend another person money. There are different intentions. Okay, so, and that also will lead us to what we call classification. Just like we did in equity, that will lead us to what we call classification. So now, in this case now, there are three possible classifications for debt. We have amortized costs, we have fair value to OCI, we have fair value to POL. So those are the three classifications. And again, these classifications depend on your intention, depends on why you have done that investment. And you see, fundamentally, the standard says that the way, the basis, how you will know how you classify, says that you should look at the business model of that investment, and also something we call contractual cash flow test. So those are the two things we look at for us to determine how we will ultimately classify it at the beginning of the year. So saying that we should look at the entity's business model for managing that financial asset, it means that how does the entity wants to make money? Because when we say business model, we are talking about how you make money. Every business has a business model. Like one business I knew that did not have business model was Instagram. When they started, they were not making money. I mean, they didn't know how to make money until Facebook bought it some years ago for, I think, $1 billion. Facebook has turned Instagram into a money-making machine. It's making billions of dollars every year now. So they now have a business model, how to make money. And of course, it's fundamentally the same for most of these social media companies. Banks, for example, now their own business model is that, okay, we'll keep your money for you, right? In fact, you can save it. We'll even give you interest, right? Now your money, they will not borrow it to some other people and charge them more interest. That's their business model. My school, Equity, our business model is we want to teach you at your convenience. You're in your house. We'll give you quality lectures like that. And then you pay us. That's how we make money. That's our business model. So coming back to debt instruments or debt investments, what's your business model? We need to understand your business model. And business model regarding debt there are two. Number one is that you want to collect interest and principal. There are some people, the reason why they have invested in whether government bonds or corporate commercial papers or corporate bonds, the reason is what is attracting them is the interest. Some people, as soon as they make 500 million, they are not working again in their life. Because, I mean, you can get 20%, 25% interest per annum. That's 100 million per annum. What do you want to eat? The own is they will just put it there. Just be giving me 100 million per annum. And they're fine. And at maturity, they will collect back their 500 million. So their own intention, the way they want to make money from that, their debt investment, is interests. And at maturity, they collect back their principal. However, there are some people, of course, when you have debt investments, interest and principal is always there. But in addition to that, okay, you might also sell also. Some people are ready to sell, especially if their debt investment is listed. You know, debt investment also are listed. The same way shares are listed on NGX, Nigerian Stock Exchange, debt also are listed in Nigerian Stock Exchange, as well as in NGX, as well as FMDQ. They are there. It's there for you to trade it on, sell it, and all of that. So some people also have the intention of selling, make some margin if possible. And I mean, the motivation for selling in most cases is when they see another opportunity that will give them higher interest. I mean, you say you want to give them 25%, but they have seen another person that is ready to give them 30%. So they will sell. So fundamentally now, the business model regarding debt investment is either you want to collect interest and principal, or you are collecting interest and principal as well as also you're ready to sell. Okay. And another basis is what we call contractual cash flow characteristics. Look at the name, contractual cash flow, which simply means that be sure that there is a contract that specify collection of interest and principal, there should be a contract that states that yes, you collect interest and yes, you collect principal. That's what this other one is talking about. So you will not find ICAN, when ICAN want to test your knowledge on how to classify in a scenario correction, they will not base it on this other part of the basis, because this one is like, it's a constant, it's something that is there. Because before you even buy the debt itself, there is a contract. So it's a given. So ICAN will not really test you around that. Is this one that has options, this business model, they can give you one of the two and ask you, okay, if your business model is to collect interest and principal, how do you classify? Okay, let's now go to using this business model and contractual cash flow to determine classification. So let's start with amortized cost. Remember, I told you there are three classifications: amortized cost, fair value through OCI, fair value through POL. You see, for amortized cost, you classify at amortized cost if your business model is that you intend to just collect interest and also receive your principal at maturity. That's all you are concerned about. You have no intention of selling, whatever. Your intention is just the interest. Let you just keep paying you interest every year. And at maturity, they should make sure they pay you your principal. That's all you care about. Okay, and of course, there must be a contract that would show that you would this is the amount of interest you're getting, and this is the principal you get back. There must be a contract that actually shows that. So that's the contractual cash flow characteristics test. Okay, so if that exists, then you can classify at amortized cost. But the major thing I think you need to put in mind is this business model test, saying that your intention is that you want to collect solely interest and principal. This one is a given. That's, of course, you can mention it in the exam that there must be a contract that shows that you collect interest and principal. Okay, that's amortized cost. So what about fair value through OCI? So for fair value through OCI, you will classify a fair value through OCI if your business model is that you want to collect contractual cash flows, that is interest and principal, as well as sell. If you also have the intention of selling, then you are going to classify that debt investment at fair value through OCI. If intention of selling crosses your mind. Okay. Of course, there must be a contract that will show that you collect interest and principal. There must be a contract that will show that. So you can see the difference between classifying at amortized cost and classifying at fair value through OCI. The difference is in that this one has that you also want to sell. So in addition to collecting interest and principal, you also want to sell. Okay. So when you also have the intention of selling, then you should be looking at fair value through OCI. The third one, which is fair value through POL, this one is used when you cannot measure at fair value through OCI or amortized cost. So you measure at fair value through POL when you cannot measure at fair value through OCI or at amortized cost. So you see, fair value through POL is like a default classification. We don't follow those bases I've mentioned that, okay, your business model, no, that fair value through POL, an entity can just decide at initial recognition that I want to classify and measure my debt investment at fair value through is allowed. That at fair value through P&L is allowed. You're free. So you can do that at initial recognition. So it's a default classification. And you see, aside debt investment, even the one I told you under equity, you know, fair value through OCI, and those classification, their basis is whether you're holding it for trading or whether you're holding it for the long term. You see, it's possible that you don't know the intention of the company, but you still have to classify it. In such case, you still assume that they are holding it for trading. So you classify at fair value through POL for equity. The same thing for debt. The default classification is fair value through POL. Okay, again, the same thing for equity. The way you classify this debt investment is exactly how you are going to measure them. Okay, at amortized cost, fair value through POL, fair value through OCI, the same way. That's how you measure them. Okay, so now the same thing I told you under equity applies for debt too, in terms of how the differences between fair value through OCI and fair value through P&L. The same thing applies in the sense that the difference is that when there is changes in the price of those instruments, the share price, in this case, the price of the debt. So where does those change go? If you are measuring at P&L, that change will go to P&L, whether a gain or a loss. If you're measuring at fair value through OCI, that gain or loss will go to OCI. That's for fair value through POL and fair value through OCI. So those ones are not anything. So the new thing here is amortized cost. So how do you determine amortized cost? You see, the idea of amortized cost is coming from the fact that on every debt investment, when you have debt, when you lend people money, you will need to pay interest. You will need to pay interest every year. And doing that is a process of amortization. So, and also it might affect the value of what you are owing, especially if you have not paid that interest at due dates. That means your principal you are owing will be growing. But fundamentally, the way interest should be paid is you amortize it over the period. You pay it annually. You account for it in your books annually. Even if you pay it lump sum, it's possible that you borrow money for 5 years or 10 years, and you are ready to pay the entire interest for those period lump sum. In accounting, you still recognize those interests on a year-by-year basis. You amortize it. So how do you determine amortization? So I'll give you two scenarios, a simple one and a more ideal one that you might find in the exam. You can find any of them in the exam, really. So the simple one which is the popular one. So on a 10 million naira 5% loan, okay, with 10 million repayable at the end of the 3-year term. Okay, so this is the popular one. You'd issue a 10 million naira 5% loan with 10 million repayable at the end of the 3 years. So which means that you invested 10 million in a loan note, meaning you are the one that lent somebody money, and they're saying they will give you 5%. This 5% means they will give you 5% every year. And they are saying here that is a 3-term loan. So that means every year you are going to be getting 500,000, 5% of 10 million. This is a fixed interest. And at maturity, they will give you back your 10 million. So to account for this one, quite straightforward, because as soon as you would invest that 10 million, you simply debit financial asset at amortized cost, credit bank, with the transaction price, which is 10 million. Okay, you do that immediately. And at the end of each year, which is year 1 to 3, you collect interest, they pay you interest, at 5%. It's fixed. 5% of principal every year. And every year, the money goes into your bank, you debit bank, you credit P&L, because an income, it goes to P&L. So with the annual finance income of 500,000, okay? So at the end of the third year, they will repay the loan, to give you back your principal, which is your 10 million. Again, money goes into your bank. Anytime you collect money, you debit bank. You credit the financial asset or loan receivable to net it off. Remember, when we invested, we debited it. Now that we are that's how these are accounted for. That's how these are accounted for. So the only thing is that, I mean, which is not something common, but I've seen it in your exams, where they will tell you that this 5%, they didn't pay it that year. They did not pay it. Maybe in year 2, they did not pay it in year 2. So that means that instead of debiting bank, since you didn't collect it, it will be like an asset to you. It becomes an interest receivable. It becomes an interest receivable for you. Then since you won't collect it instead of debiting bank, because it's still going to P&L. Whether you collect it or not, it's an income, it goes to P&L. Okay, that's for this simple one. It's very direct. And you will find out that your financial assets in year 1, in year 2, in year 3, year in, year out, it doesn't change. It's 10 million, nothing affects it. It's just there. And at maturity, they give you back your 10 million. And I've shown you how you net it off with this double entry. Okay, so you see, the issue arises here. Look at this scenario now. So this one, again, this is another scenario 2. So you'd invested 10 million. You give somebody 10 million, right? So that person, okay, he's going to give you 5%. But then at maturity, the guy says he's going to give you 11 million back at the end of the third year. Okay. So you see, that last example I gave you, you see, over the 3 years, you will have made 1.5 million. Since you're doing 500,000 per annum, 5% every year, 500,000 per annum. So you'll have made 1.5 million. This one, how much would you have made at the end of the third year in total? Anybody?
This should be 2.5 million because there is additional 1 million to that 10 million.
That's
That
absolutely
makes
correct.
it.
That's absolutely correct. So please listen up. If you're sleeping, you want to wake up now. So yes, it's correct. You have made 2.5 million. However, you see that 2.5 million here, they are both income. They are both, in fact, they are both finance income, or you call it interest income. They are both interest. But this 5%, the pattern of recognition is clear every year. It's 5% per annum, which is how accounting works. We expect to recognize income every year. But this remaining 1 million, this extra 1 million, you see, one will be tempted to think that since you are collecting it in the third year, because they are paying it at maturity, so it means that 1 million will recognize it as income in the third year. Then that will be wrong, because that will mean that you're recognizing that income on a cash basis. That's wrong. The right way to do it is that 1 million, you should recognize it over the 3 years. Because, yes, you earned it over the 3 years. The only reason why you're getting extra 1 million is because you left your 10 million with them for 3 years. If you sell it in between, you won't get the extra 1 million. So that extra 1 million should also be recognized over the 3 years. So how do you then recognize it? Should it be equally? No, the standard doesn't allow that. What the standard recommends is that What instead of that means try to convert that extra 1 million also to a rate in such a way that instead of recognizing just 5% as income, by the time you get a rate, okay, so that means this rate 5% might become higher to reflect that extra interest you're earning in form of that 1 million. Then that will help you. And since this one is already per annum every year, so it makes it easy for you to recognize income, that 1 million every year. Not 1 million per se every year, like a portion of that 1 million every year, so that you will have recognized that 1 million over the 3 years. So you see, that method, that approach of converting this 1 million into a rate, the standard calls it effective interest rate method. Effective interest rate method, meaning the examiner will give you an effective interest rate. They will give you an effective interest rate. They would always give you in the exam. So in this case now, the appropriate effective interest rate is 8.08%. 8.08% effective interest rate, which means that when we say effective interest rate, it means the income you are earning, okay, is this 8.08%. And this 8.08% is this 5% per annum and a portion of this 1 million. In fact, and this 1 million, that's what the one they converted to rate. Okay, that's why you're having an higher rate. So this one has already encompassed the two. So it is this 8.08% now that will now go to your P&L. I hope you're getting me. I'm saying that the income you are earning now is more than 5%. So it's unlike the previous example that we did, where it's solely this 5% you are earning every year. So it makes sense to recognize 5% to income every year. But now you're recognizing an extra income. So I'm saying the question will give you an effective interest rate that will have captured that extra income. So it's not this 5% that you take to P&L anymore. What you take to P&L is this 8.08%. So when you have a question in the exam where they give you have both nominal interest rates and the effective interest rates, then for you to determine that interest that go to P&L, you need an amortization schedule like this. Very easy. The thing is that you will always have to do this. Anytime you have both effective and nominal, you will always have to do this. So let's say in year one now, 2001, we invested 10 million. I call it balance at the beginning or balance brought forward, 10 million. The effective interest rate, which is now our income, 8.08%, you apply that on the opening balance. That gives you 808. That's your income that has encompassed all your interest for that year. The 5% and the premium encompassed everything. However, remember that the premium, you're not collecting that now. You are collecting that in the future at maturity. So that means this 808 is not what you collect. The only portion you collect is this 5%. That one you're sure they will pay you. So this is the only portion you collect, and that's 5%. This one is always this fixed interest is always calculated on the principal, like per annum. It's a fixed interest. So that's 500. So we are saying out of 808, you only collect 500. That means you are still expecting 308. So you then add it to your investments. So that means the balance in your financial asset accounts will be 10,308. I hope you're listening. Will be 10,308. So it's like saying 10,000 plus 808 minus 500. 10,308. So you carry this 10,308 to the next year, that's 2002. So you have 10,308. Again, your income in the next year, which we call effective interest, will be this 8.08% multiplied by 10,308 gives you 833. This is your income, but again, you're only going to collect 5% of the principal. This one is fixed. You see, it's the same thing in year one and year two. 500. So by the time you do 10-3 rates plus 833 minus what you collect, you will see that they are owing you 10,641 as your investment, which are going to carry forward to the third year. So 10,641 opening. Again, you apply the 8.08% on that. You get 859 as your income. You are only going to get 5% of the principal, which is 5% of 10 million, which is 500,000. So by the time you do 10,000 plus 859 minus 500, you get 11,000 as the balance of your investment. This is how you have to do it. So the core thing here is this. I think I shared you a question. Most of you did not do it because I think maybe I haven't taught you. So you can, there's this question I call test 3 and test 4. Yes, you should be able to attempt it now with this one I just taught you. Test 4 is a past question. So it's something similar that I can give you a scenario like this. They will give you both nominal and interest rate and ask you to calculate the amortized cost. You will have to use this table. Is no more than this. And you see, from this table now, this 808 is our income, is the entirety of our income every year. 808, it goes to P&L. While this 10308 is the value of our financial assets. You see, in this year one now, this 10308 will go to non-current assets because we are not collecting back our money until after 2 years. You see, in year 2, this 833 is still our interest income. That's our income. That's the totality of our income. While this 10641 is the value of the financial assets. But now, in the second year, it becomes current assets. Since we are getting back our money next year. So in the second year, it becomes current asset. Also, in the third year, this 859 is our income. It goes to P&L as interest income or as finance income. This 11,000 is still our financial assets, but under current asset again. And don't forget, this guy already promised that he's going to pay us back our 11 million. And fundamentally, this table has, see the way this 10,000 automatically became 11 million from applying this table. So as soon as we collect back our money, we debit bank, we credit these financial assets, and that's it. It's smoothing out neatly. And again, you will see that Latif told us when I asked that how much are we making over the 3 years? He said 2.5 because 5% per annum plus 1 million. The 5% per annum is 500,000 every year, which is 1.5 million, plus 1 million, which is 2.5 million. So if you add these 808 plus 833 plus 359, which I told you is our actual income, which is the 5% and the portion of the premium that we are spreading every year. So that means now that we have finished spreading everything, we should get 2.5. And if you add it, you will get 2.5. Any extra decimal or whether 2 naira or that is on that 2005 is just approximation error. So that shows clearly that this 8.08% effective interest rate actually helps us spread that premium over the 3 years. Okay. Any questions? Because that's all.
Approximately 2.5.
Yeah, exactly. So to give you 2.5. To give you 2.5. That is all. It is not more than this. ICAN will not ask you more than this. So somebody is asking me that, is the effective rate what we call coupon rate? No. It is the nominal rate that we call coupon rates, which is this 5%. The actual, this is the fixed interest rate that is called coupon. not the effective. Effective, another name for it is market rate. Any questions? Aisha, ask me a question. Oliver, you're becoming too quiet in this class. What's happening? Those are my students. When we just started, I used to ask questions. Now
My
they're
question, sorry, my question is this accumulated rate, like the new rates that you join together, both the final payment and the initial, will it be given by the examiner or we have to work it out?
They will give you this effective interest rate, Abby.
Yes.
They will always give you.
Okay.
They, in fact, the thing is this, as soon as in the exam, you see that they give you effective interest rates, know that you will do this table. Because if they don't give you effective interest and they just give you 5%, that one is straightforward now. It's just like the first one I did. The only thing that goes to P&L is just the 5% of the on the principal every year. And the principal remains the same every year. So that one is straightforward. You only do this table when the effective interest rate comes in. The nominal will always be given. That one is always there because that's the interest, that's the fixed interest, that's the coupon rate. But as soon as they introduce effective, that means there's some variations in cash flow. That means there's an additional income you're earning somewhere. That's why you're having an effective. So you will have to do this table. And it's no more than this. Except if there's also want to like that question I sent to you. That test 4, you should be able to attempt it now. So that will be your assignment. You're supposed to submit it before the end of tomorrow. Your colleagues in our physical classes have already submitted theirs. So you need to submit your own as soon as possible. And the question I shared with you guys on intangible assets, I see that none of you on this platform did it. I don't know why. I have to do it. It's an assignment. Any questions? Okay, since you're not asking me any question, so I'll direct this question to any of you. This 808 that is going to P&L, right? Which is our income. I mean, you're learning that what goes to P&L is the effective interest, not this 5%, because this 5% is already included in this 808 already anyways. So you should always remember that this is what goes to P&L every year, these figures. But my question is this, I just want to be sure you understand it, because I take that very seriously. What's the double entry for this 808? Because a new transaction, what's the double entry for it? Wow, nobody. Well played. Okay. This 808 will simply credit P&L, debit the financial assets, or instead of debiting the financial assets, you can debit interest receivable. Okay. This 500 that you are actually going to pay, that you are receiving, because this is an income. So you debit bank, you credit the financial asset or interest receivable. And that applies to the second year and the third year. Anyway, in your notes, it's already well explained there. I've already done all of that there. I just needed to mention it to your hearing. Okay, so that is for financial assets. You see, for financial liability, it's very similar because the peculiarity of financial liability is the fact that you are not the one that is borrowing money now. You are not the investor anymore. You are the one that collected money, you borrowed money. And you see, for your exam, so let me be exam specific now. Financial assets will be classified and measured at amortized cost. They are usually classified at amortized cost. They are measured at amortized cost. Okay. And I've already taught you amortized cost. So I think I'll just give you one more example so that we can wrap that up. But I need to mention that for financial liability, they are initially recognized and measured at net proceeds. Please note this one. Oh. They are initially measured at net proceeds. And this net proceeds is simply the cash you borrowed or the transaction price minus any issue cost. This issue cost, I mean that transaction cost. See, when you borrow money and you incur transaction costs like issue costs, like stockbrokers fees and the rest, you deduct it from the money you borrowed. So liabilities are initially measured at net proceeds. So you really need to note this. They are initially measured at net proceeds. But at the end of the year, the classification and measurement is amortized cost. So let's look at this very simple one. I'll just add one more thing there, just to, I know I've covered everything you need to know on that one. So Wasi PLC issued. When you see issued, you should know that he's not borrowing money. When he issued, he's not borrowing money. The other one is when he purchased. That means he's the one investing. That's when he has financial assets. He has purchased an investment. He has purchased an instrument. But when he issues, it means that he's saying, come and borrow me money. So he issued 10 million, 5% loan notes on 4th January 2001. He incurred issue cost of 200,000 and is repayable at a premium of 1 million. At the end of the third year, they now give us an effective interest rate of 8.85%. So immediately you see effective interest rates and nominal rates. That means you have to do that table. You have to do that table. So let's just do that table here. So to leave stories. In the first year, we are recognizing 9.8. Why are we recognizing 9.8 instead of 10 million? Because he borrowed 10 million. Why are we recognizing 9.8 million? Anybody?
Less the cost, the charge is 200, incurring 200 issuing cost.
Thank you very much. Because I already taught you that you initially measure liabilities at net proceeds. Okay, net proceeds. So if you miss that, you miss it. You miss all. If you miss this one, you miss all. So please don't miss it out. So initially is net proceeds, except if they didn't give you issue cost. If they give you, make sure you deduct it. So the effective interest, which is 8.85%, you apply that on the 9.8, it gives you 867. The fixed interest that you're paying as interest, this one is always on the principal. You'll be very wrong to go and apply that on 9.8. You pay interest on what you borrow. So you borrow 10 million, you pay interest on 10 million. So 500. Just like I've taught you before, 9.8 plus 867 minus 500, it gives you this. So it is this 867 that is our cost, not this 500. Anyway, this 500 is included in this 867. I'm saying that in addition to this 5%, there are other costs like premium, issue costs. All of those are part of our finance cost. So it's 867. So that's what goes to P&L as finance cost. So by the time you add the 867 to 9.8, you remove 500, we get 167. So we carry this to the next year. You apply the interest, the 8.85%, the 10,167. That gives 900. Our fixed interest remains 500. So by the time you do 10,167 plus 900 minus 500, we get 10,567, which we are carrying to the next year again. So would also apply this 8.85%. Gives on 10,567, that gives 933. We get the fixed interest 500. The balance gives us 11,000. Just like the first one. Again, if you confirm this 867, 900 plus 933, the total finance cost over the 3 years will give you 27. That goes to show that this one has helped us recognize those costs over the 3 years. Because if you look at it, we are earning 5% per annum for 3 years. That's 500,000 every year. That's
2.7.
That's 2.7. Okay. Which is this 5% per annum, which is 1.5 million for 3 years. Add the 200 naira issue cost, add the additional premium we are paying. That's 2.7. Okay, which is the addition of this trade. So that's the length they can go to. And don't forget the double entry. This 867 is like we are debiting P&L and we are crediting financial liability or interest payable. This 500 is like we are crediting bank and debiting the financial liability or interest payable, because this is what we are actually going to pay. Well, this is our income. This all goes to P&L. Well, this 10,167 in the first year is a non-current liability. In the second year becomes current because we are paying it next year, and it's current in the third year. So as soon as we pay, we just credit bank debit the financial liability with 11 million. This goes off our books. This goes off our book. Any questions? So finally for tonight, before we go and sleep, there's something we call convertible instruments, or what we also call it compound financial instruments. Remember what I taught you under IAS 32 to know whether the issuer has a financial liability or equity. You remember that clearly, the one I gave you assignments on, to know whether the issuer has equity or liability. So you will find out that there are some instruments you will issue that it will make you have the two, both equity and liability. And in one of the assignments I gave you, one of the solutions is a compound financial instrument. And what can lead to that is when you issue what we call a convertible debt, either a convertible debenture or a convertible loan note. Convertible debt generally, anytime you issue a convertible debt, it gives rise to a compound instrument. And how? You see, the nature of convertible debt is that you're telling the investor, you're telling the person that wants to give you money, that wants to lend you money, you are telling them that at maturity, I'm giving you the option to convert this your money to shares. That is, instead of collecting back your principal, why not convert it to shares? That's convertible instrument. That's a convertible debt. Okay. But the special challenge is that we are not sure, because the choice of whether they are collecting money back or they will convert is in the hand of the investor, the debenture holder. They are the one to decide. And we cannot know what they will do. We don't know whether they would convert to shares or whether they will not convert. So because of that, when we are accounting for these convertible debts, we usually account for it as both liability and equity. You know that if we are sure that they will convert to shares, right from day one, we will have treated it as equity. if we know that the way we are going to settle is to give them shares, it will have been equity right from day one. Or if we know that we would have to deliver cash at maturity, we will have accounted for it as just liability. But the only reason why we are considering it as both liability and equity is that we are not sure. We don't know which one they will do. So we need to be prepared for the two. So at the date we are putting it in our books, we need to recognize both liability and equity. I mean, it's very easy to say that we recognize liability and equity. It's so easy to say. The challenge you will face in the exam is that how much of that amount you borrowed are you going to recognize as liability? How much are you going to recognize as equity? That's the major thing the examiner will test you. It's just like you borrowed 10 million using a convertible debt. And IS 32 is saying that because you are giving option to the investor to convert, and you're not sure which one is going to do, that means this 10 million, a portion of it you recognize as liability, while a portion of it you recognize as equity. Yeah. So how much of the 10 million is liability? How much of the 10 million is equity? That's a major challenge. And how do you conquer this challenge? Easy. You'd focus on the liability part first, because equity, as defined by conceptual framework and IS 32, is a residual interest in the asset of an entity after deducting all liabilities. So because equity is a residual interest, you only consider it last after you have determined the value of your liability. So the focus is, let's get the value of our liability first. That being established, then how do you get the value of your liability? Also very easy, because what you're trying to do is that I want to get the value of my liability today. And when you look at liability, the value inherent in it is two. Number one, the interest you are earning per annum, or the interest you are going to pay per annum, and also the principal you will pay at maturity. Knowing that these are the inherent cash flow in a liability, just discount them to present value and add them together. That's the value today. That's the value. Discount them to present value and add them together. That's the value. And as soon as you identify that, you're done. I mean, this is best explained with a question. Look at this question. Very limited. He issued a 4,000 convertible debt at 1st of January 2021. The bonds have a 4-year term and are issued at par with a face value of 2,000 per bond, giving total proceeds of 8 million. Interest is payable annually in arrears at a nominal annual interest rate of 6%. Each bond is convertible at any time up to maturity into 250 ordinary shares. When the bonds are issued, the prevailing market interest rate for similar debt without conversion option is 9% required. What is the value of the equity component of the bond? Okay, again, this guy issued a convertible bond, which means that he's giving the investor options to convert to shares. So he issued 4,000 bonds at 2,000 naira per bond. That means he has borrowed 8 million, which is 4,000 times 2,000. Okay, so they wrote it here, 8 million. And he has promised to pay 6% per annum. Knowing that this is a convertible bond, it therefore means that we will need to, this 8 million, at this date we borrow the money, we need to split it, we need to bifurcate it, we need to separate it into liability and equity. To do that, we need to firstly determine the value of the liability. As soon as we determine that, you're done. To determine equity component is just the balancing figure. And to determine liability, You will get the present value of the interest and the present value of the principal. Knowing fully well that this is a 4-year term loan, means that you're going to get interest for 4 years. And the interest is the nominal interest rate of 6%. This 6%, the nominal annual interest rate of 6%. On the principal is constant every year. So we do 480,000. 6% of 8 million is 480. We'll discount that to present value using 9%. Why am I using 9%? 9% is the market interest rate. And that is the market interest rate for similar bond without conversion option. And you should not be surprised that this 9% is higher than this 6%. It should be, because this 9% has more risk because they don't have conversion option. The reason why people are still borrowing us money, are giving us money at a lower rate than market, is because they believe they are safe. That even if we default on payments, they will still get shares. So the risk faced to them is reduced compared to that of the market. The market is really accepting a premium because they believe it's a more risky investment. But when you're doing discounting, we use market rates. That's why we're doing discounting factor at 9%. And because this is an annual equal payment, for us to get the present value, we will use an annuity formula, which is 1 minus 1 plus r raised to power minus n over r. I would advise you to learn how to do this on your calculator. Ordinarily, in recent times, ICAN will give you this figure. They will give you these two. They will say this is annuity, this is discounting. They'll wait for you and see which one you will use. A good financial reporting question should not be asking you this one. This is not really, it should not be asking you all this in financial reporting. It's just for you to know that we apply annuity. So the answer is 3.240 when you apply that formula. When you multiply that by the interest per annum, it gives you this 1,555,200. That's the present value of the interest. Again, you get the present value of the principal. Which is year 4. And the present value of the principal, first, the principal is 8 million. To discount that present value, since this is just a future value, it's just 1 year into the future, you simply use this formula to get the present value, to get the annuity factor, to get the discounting factor, 1 plus r raised to power minus n. Giving r at 9% and n at 4 gives you 0.708. If you multiply this by 8 million, gives you 5,664,000. When you add that to this 1.5 million, you get 7.2 million. 7,219,200. And this 7,219,200 is the value of the financial liability. That's the value of the financial liability. And as soon as you get that, to get the equity component is so straightforward because it's the balancing figure. Don't forget that what we borrowed is 8 million. Since what we borrowed is 8 million, and out of that 8 million, 7.219,200 is liability. That means the balancing figure is equity. So our equity is 780,800. It's 780,800. So at the date we borrowed the money, that 8 million has been splitted between the liability and equity. So and the journal is you are debiting bank with the money you borrowed, you're crediting liability with 7.2 million, Then you credit equity reserve because this equity is not like we are issuing shares. So put it in a reserve, which is the 780. That is all. That is all. That is how you deal with compound financial instruments. That's how you separate it. Now, I need to mention this. Let me just wrap it up. You see, at the end of the year, at the end of the first year, this is 31st December 2021, you see, your reserve remains your reserve, but this your liability will not remain 721,900 at the end of the year because this one will earn interest. So at the end of this year now, this liability, because right now we are having two rates, we are having effective interest rate and nominal. That means we have to do that table that I taught you to get the value of the liability at the end of the year and the interests, because you get interest payable and interest paid, and we have also balance carried forward. So the balance brought forward is the value of the liability. The interest payable at 9%. Do anybody have calculator there? What's 9% of 721,900? Anyone with calculator?
649,728.
Okay, 649,728. The interest paid at 6%. How much is that? That will be on the principal. That's 6% of 8 million. That is 480, which we are going to deduct. So if you do 721,900 plus 649,728 minus 480,000, what does that give us?
Seven million 388,928.
Okay. And that will be the value at the end of the first year. So, of course, you have to know how to do this because they can ask it in the exam for just the first year. And you need to know that is this 649,728 that will go to our P&L as finance costs. That's the interest payable based on the effective interest or the market rate. While under your non-current liabilities, this will be your financial liability, 7388928, that will go into your statement of financial position. I promise you, it's not going to be more than this. Just learn this with this material. And I hope it is this material you are using. You'll be making a great mistake if you leave this solid material that we gave you for free. Or I should just do like others are doing. So you'll be very wrong to leave this material. You're not reading something else. You'll be very wrong. You'll be using a very wrong approach. I mean, that will be allowed only if you have read this one. Then probably you have a lot of time at your hand. Instead of revising it again, you want to read something else. It's okay. There's nothing wrong with that. I can confidently tell you that this is tested. It's developed over plenty years. It has a lot of simplicity, what you need, straight to the point. It's what you need. It's what you should read and read over again. And it covers everything in your syllabus. And it's just 391 pages or thereabout. That's what myself and Mr. Beldi is using to teach you. So it has everything you need. Just read it. Solve all the questions inside. And again, I'm going to give you this as assignments. This second one. I know the solution is in your, just solve it yourself, compare with the solution. It's the same thing as this one. I'm not going to resolve it again. And guys, do assignments, solve these questions. Exam is close. And in case you are not aware, We have just 6 classes to go. Just 6. Where we are going is not far from where we are coming from. The number of times we have met is now, it's now higher than the number of time remaining for me to beat you. Okay, and I mean, essentially, that has also necessitated that makeup classes that we have ignored for some weeks now. So be expecting my call, probably be looking at either IFRS 15 or IFRS 5 on Thursday, just to double up some little things. Because by second week or third week in April, I would majorly focus on published. I want to put all of these things together and see how you solve questions on published, which I believe then would be a little easier for you. That's if you have been reading all of these things. So please, guys, you need to, let's double up, please. Because what I have to do is not so much again. I'm already netting up. By next week now, I'll be teaching you impairment of non-current assets, and I'm going to finish it the same day. After then, I'm teaching you IFRS 16. Worst case, that will take 1.5 class. After that one, I have just little. Probably I'll teach you ratio. Then Mr. Abe, I'm sure you should have finished group accounts. Then you should be entering, you should be teaching you things like cash flow, EPS, provisions, income tax, like that. So he still has, I mean, within the time he has, he will cover everything he needs to teach you also. So these things are not so plenty, but you just need to practice them because ICAN will go length and breadth. So then on Thursday, there are some things I've slated for that, which I'll start driving on. And of course, we'll cover. So before I attend to Latif's question, I need to tell you 3 things. 3 things. Please pay attention to these 3 things. Number 1 is that when an issuer issues a financial liability, the dividend he pays or the interest he pays to the investor, the people that gave him money, that interest will be treated as expense, as a finance cost in P&L. To be treated as a finance cost in P&L. Okay? But if what he issued is an equity instrument or share capital, if it is an equity instrument, that's the dividend or the interest he pays to the investor be treated as a share of profits. I mean, it will be treated as a deduction from retained earnings in the statement of changes in equity. Okay? When what he issues is an equity instrument, that will be treated as deduction from retained earnings in the statement of changes in equity. And finally, when you incur transaction costs during an issue of equity or share capital, such transaction costs will be deducted from share premium. See, this is what I'm summarizing. I think it's important you know it. That is the end of financial instruments.